Yeah, so I'm actually recording this session. Yeah. So yeah, so these would be an overview of what things to be expected from this webinar series. Apart from this, if you guys want anything to be discussed in this series, you can definitely put it in the WhatsApp group, or you can inform us through LinkedIn, or however, in whatsoever manner you can discuss. So I'm not telling, like I said in the initial uh, time, these will not be the only thing what we would be discussing. We can discuss any other thing which is a kind of most I don't want to discuss a very unique problem which one or two founders are facing, but I would like to kind of discuss a very general problem which can be kind of connected to mostly say 40, 50, 60% of the audience. Okay, so yeah, so we are actually going to step into this particular episode. Yeah, so yeah, so like I told, this is the thing what Ajay was mentioning earlier. So here, see how startups are different from other businesses. So this is something what we actually need to understand, how startups actually differ from other business. So whenever I meet a business owner, whenever I meet somebody, see the common notion what people have is somebody who starts something is a startup. So which is actually very wrong. So see, in a literal sense, that is correct. So they are starting something, so it is a startup. But when it comes to a technical perspective, when it come to a startup ecosystem kind of thing, or when it comes to even the definition that the government gives, uh, startups actually differ a lot from other businesses. So that is something what I need to actually speak to all of you about. So the fundraising in startup is actually, I mean, entirely different from the fundraising in SME and other businesses. So both of them are kind of, what to say, like completely different. The procedure what we have to follow, what all are the tools that we should be using for the fundraising process, and how to approach the investor. What are the investor expectation? Everything is entirely different from a startup and an SME or other business. So we'll actually see these four what you're seeing on the slide are not the only factors what actually differentiate startups from other businesses, but there can be other factors as well. But yeah, Ajay, is there something that I want to ask? Yeah, scalability is what I actually meant by the growth rate. Yeah, does anyone have a question on it? Can I continue? Yeah, okay, sure. So yeah, so these four are not the only factors that differentiate a startup and other business. There can be many other factors, like somebody was telling scalability. So scalability is actually included in the growth rate in my purview. So yeah, but scalability is something what differentiate from other businesses. So yeah, so a couple of days back, we were actually having a session in our office where one of the founder, one of the entrepreneur come and meet our teammate, and they explain their business. They also speak about what do they expect from us as a consultant, us as a chartered accountancy firm. So in that session, this client was actually explaining very beautifully about the difference between startups and MSMEs. See, the thing what he used was the term what he used was irrational growth. So the growth in startups is irrational. So it's kind of beyond logic. It's beyond our rational thinking. So a startup can grow from here to like kind of there in no time. But a conventional business or another business are kind of bit more stable oriented. Like there is scalable, but I mean there is scalability, there is a growth rate, but it cannot be in such a great pace. So I'll tell you an example of a conventional business, and I mean a business or and how startups are different. Suppose see, I'm a chartered accountant, okay, and I'm doing consulting for my clients. I'm doing bookkeeping for my clients. I'm doing audit for my clients. So, but I have a huge manpower. I have like kind of a few people working in my office, helping the clients sort these things. If you ask about the growth rate and scalability in my model, it is actually limited. So, in order for me to scale up, I will have to hire a lot of people. I will have to kind of do aggressive sales and everything. So, there are many things which actually restrict me from scaling up my business. So, even if I get many clients, say I get 100 clients in the next 1 month, I will have to hire like kind of 50, 70 people to deliver that work. So the scalability in my case is actually very difficult. But if I add some technology element to my business, wherein suppose I'm selling a software, I'm creating a product, a software product, which actually solves the that software product may be acting as a consultant for that, consultant for a business. So you can ask your queries to uh, the software, and the software would be replying you. Then this can be made as a subscription model. In that case, this is going to have a kind of very high level of growth, like compared to the model which I am operating. So the current model what I am operating can be taken as an example for a business, and the technology involved model what I can develop can be made as a can be taken as a startup. Okay, so that is one thing. Then a risk is there. So startups are too much risky. Other businesses are much compared. See, there is risk in every business. I do agree with that. But startups are too much risky. So consider the same example. I actually put in a lot of money. Actually take some fund. I actually put in a lot of money for the technology, and eventually people don't use my software, or there is some issue with my software, or it is not actually solving a problem. So the risk of failure rate is very, very high in a startup. On the other side, my other business, it is more kind of a stable model, wherein, okay, I get some client, I have this much employees, so they will be working on that. So it's the element of risk is actually very less in that business model what I am operating. I hope that is clear. Then there is this innovation factor. So innovation is a very, very important factor for a startup. So, see, even in the definition that government give for a startup, innovation is one of the definitions that they have added for the startup. I mean, one of the elements that they have added for the startup definition. So, the startup should be innovative. That is one definition in the startup. This one. So, and considering the same example, what I told, like in the conventional model what I am operating right now, there is like innovation is very limited. Maybe I'll be doing something different from others, but that may not be that innovative. But if I bring in the technology factor, if I kind of create a SaaS product or something kind of that, then the innovation would be there, and then it can be coined as a startup, but the other one would remain as a business. And the other one is the investor expectation. So this usually is not a differentiating factor, but why I have mentioned investor expectation is that the question what Ajay raised in the initial point. So the investor expectation for the investor who invests money in the startup and who invests money in a business is entirely different. For example, like I told, I'm doing consulting business. I'm getting an investor. So the idea of my investor would be to invest some money into my company and get a return on a monthly basis or annual basis or whatever. Like it can be a fixed rate of interest. It can be a share of the profit. So suppose he puts in 20 lakhs, I can give him 20% of the profit. So that model can be worked out. That is how the investor expectations are. So they are actually looking for immediate return and also kind of some return on a perpetual or a long-term basis. So they are not actually ready to wait for 5 years or 3 years to uh, make my business profitable and then get some return. So they are actually looking for short-term return, but for a longer period. So I hope that is clear. And but when coming to a startup, the investor expectation is entirely different. So they're actually ready to wait. They're investing and betting on the startup. They want the valuation of the startup to grow, and they are looking for wealth maximization rather than yearly ROI or monthly profit distribution or anything. Like they are looking for more of a kind of value creation for the startup So suppose say the same startup person, the same investor invests say 20 lakhs in my startup. It's a technology startup, okay, not the conventional business. People invest 20 lakhs. So and I give him 20% of the company. So obviously my valuation is 1 crore. And after 3 years, I sell my company to somebody else for 10 crore. So definitely, then also you'll be getting 20%, and you'll be getting 2 crore rupees for the investment that he has made. So that is the investor expectation in a startup. So they are looking for wealth maximization. They are looking for valuation and everything. And yeah, so these are the main 4 factors I have actually noted down differentiate startups from other business. And like somebody was telling, the scalability factor. Like startups are very much scalable, and the conventional business aren't scalable to an extent. Like I told, the model in which I am operating, it is actually very difficult for me to scale in this model because it is going to be kind of a very much manpower extensive. Like I'll have to deploy a lot of employees because it's directly providing service to the customer. So I need to have more people, and in that case, I need to find right resource. I need to give salary to these people, and also I should have that amount of work also coming into my company. So it's actually difficult to scale up a conventional or other business model. Uh, but in the startup thing, like I told, if there is a technology element, it is easy to scale up. So having said this, I'm not sure whether you guys have a feeling like startups are much better than other businesses, but I don't agree with that fact. Uh, Me being a business owner, like not from a startup perspective. And as a chartered accountant who see a lot of startups and businesses, I do value both on a same note. The reason being, so some businesses are meant to be profitable. They can be sustainable model. It is a profitable model. It is also actually solving a problem. It is also actually giving employment opportunity to many people, and it is also helping the entrepreneur make money. It is also profit making. It is self sustainable. It can be a bootstrap business model. Even people needn't actually kind of raise money from the investors, and also everything has value, and it everything depends on the mindset of the people. So if you're building some startup or something, then definitely it should be unique, it should be innovative. But if you have a business model which can be made stable, then take it in that manner and approach it in that manner. Don't look for VC funding or angel funding in that model, wherein the investor expectation is going to be entirely different from what you can actually provide. You will be building a stable business model, and you will be making steady returns, and the investor would also be getting return. But the investor is not expecting a steady return. They may be requiring your company to be they're looking for an exit. They will be looking for an exit. So there is a difference in that case. So I hope this session is clear to everyone. uh, if this is clear, can you just type out like it's clear in the chat box? Yes. Okay. Okay. So, does anyone have any query at this point of time? If there is something, maybe we can have a 5 or 2 minutes Q&A thing. If anybody want to be unmuted to ask questions, just raise the hand. I'll unmute you. Okay, Ajay. I'll see to that. Is it better now? Is my sound better now?
Yeah, it is better. Yes, better.
Okay. Yeah. So, does anyone have any question?
Yes, I have.
Yeah, please go ahead.
Hi, Abhijith. My name is Bijosh.
Okay. Hi.
Okay. Hi. Actually, I'm working in Kuwait.
Okay.
Okay. Actually, I'm new to this business and startup. I don't have any idea about startup and business. So can you clarify in clear way, startup more definition about some example with some examples about the startups.
So, like example is what I told right now, like how my business can be made into a startup and how my
Mhm.
business is currently not a startup. So
Okay. Okay.
I'm not sure whether you were present during that point of time where I actually differentiated that.
Yeah, I was present. Right.
Okay, so to give you example, like see, if we look some tech companies, maybe kind of unicorn companies like Open or maybe Flipkart uh, or even Byju's, Upgrad. These companies are actually startups. These companies are kind of particularly startups. But if you look other models like it can be Reliance, it can be Tata, it can be Automobile Mahindra. These companies are more good examples of businesses, and the other one are kind of example of startup. So one interesting thing what we can be noted is at some point of time, I'm not now, like some few years back when Oyo had a good valuation, Oyo was valued more than Taj Hotel. So Oyo was never owning a hotel as on its own. Oyo was like kind of it's kind of a marketplace for hotels. It's just an e-commerce aggregator, but that company was valued more than Taj Hotel, which actually has a lot of hotels, which actually has a lot of properties and all. So Taj Hotel is an example of a stable business, and Oyo is an example of a startup. Okay.
Okay. Great. I understood now. It is clear
Yeah.
now.
Okay.
Thank you.
Okay.
Thank you.
Yeah.
Okay. Please go ahead.
Yeah. So I agree. So yeah, see, it can be told like that, like, but even then, that innovation factor and that growth factor and everything is there. So technically, startup is there is a government definition for startup. I think it is 10 years and 100 crore turnover. So once you complete 10 years and or you complete 100 crores of turnover, then you are automatically out of the startup definition. So in that case, yeah, I guess we can tell like this, like, see, it doesn't actually mean that a startup should be loss making, or it's not a stable model or anything. Uh, these factors actually differentiate, and I think it should be understood from a more kind of a starting point of time rather than a later point of time. So after some point, it's all about kind of building a stable business model, like providing all the stakeholders, like the entrepreneur, the investor, the employees, and the customers with good value, like in service or anything. Yeah. So yeah, so we are actually see the thing. So Ajay, actually there is some bug from our side. Like I can see multiple Ajay Sonkar in my list. I don't know why that is happening. So I am like kind of unmuting you once more. Can you just raise your hand once more? Yeah, I think you're unmute now. Hello, hello, Ajay. Just a second. Okay. Yeah, I think the rename option is there. So yeah, I've actually enabled the unmute option now. So yeah, so whoever is having the doubt can. actually.
Hello.
Yeah, hello.
Good evening, sir. This is
Good evening.
Jagdish Solanki. Sir,
Yeah.
I am also CA. Sir, I have
Hi, hi.
hello. Sir, my question is that normally we know the B2C startups like Oyo, uh, Jiroda. This is all our B2C startups, sir. But suppose it might be possible that B2B startup is also there who
Yeah,
also
definitely. There are there are a
so
lot of B2B startups. Yeah.
but some not exactly they are not just uh, their final product may not be the innovative, but they might be have done some process improvement or some kind of development in the process or system
Yeah.
in a term. So can it is allow recognized as a startup if they do the something implement in their process in the company itself?
Yeah, definitely. See, the government of India definition for startup is that it should be innovative, it should be solving a problem, and it should either improve an existing process or solution. Like suppose we have a solution now, it should actually improve the solution,
Means
existing solution.
their final product will be the same, but they might be use some technology like nowadays we are generally hearing the 3D printing house, 3D printing house. So let's say the final product will be the same, but if they use some technology or some kind of use, so they can improve the processor. So whether that process we can consider as a startup for that purpose.
See, that is what I'm telling. Like, we should be considering the scalability factor and the other things also there. Like, see, the 3D printing kind of thing, they might have improved a process, but it is definitely a capital intensive thing. And so they will have to kind of get a lot of machines for that, in order to them for to scale up. They may be having order for the number of machines that they have now, but each time they will have to procure a new machine and get it. So I wouldn't see. You can get a startup in the registration for such companies. That's not a big deal. But if you ask me that is there a startup as a consultant point of view, I wouldn't tell them to go for the startup funding route. I would ask them to go with some steady investors who are actually kind of interested in investing in businesses and getting. I mean, they work on a ROI basis or some partnership model.
Okay.
Yeah.
Yeah. Hi.
Okay.
Yeah. Hi, Abhijith. This is KL here. Can I ask a question? I'm from Bangalore. KL
Yeah,
Kumar.
sure. Yeah. Hi, KL Kumar. Hi.
Very interesting sessions, and thank you. I work closely with the MSMEs, and last assignment was with IBM as an associate partner. I'm based out of Bangalore. One question that I have is I do also get requests in terms of startups looking for funding and things like that. So one of the things is, before they go in for a Series A or, funding from any venture capitalists and all of that, sometimes they look in for some initial seed investments, right? And then they want to bring it to some minimal kind of a thing before they are actually able to pitch it to VCs and other investors, right? Now, even there, while you might have forecasted financials and all of that from revenue and all of that, how do you actually evaluate? Because if it's going to a route of some equity stake, right? They still talk the language of 1%, 2%, and all of that. So is there any, even at an early stage, where there is actually no pitching for VC funds, but there is some sort of a short-term borrowing which probably will be paid? Is there some way where this is evaluated purely based on the financials forecasted, but again there is no collateral security or anything? So there was one peculiar case, and I didn't go ahead with that because it was all unsecured, and this was more in the brewery kind of industry. So I just wanted to know, without getting paranoid, is there some measure to actually evaluate what that would be and see if
see, actually, the evaluation of a startup from an investor perspective and also from a financial perspective or from a consultant perspective, it all differs from person to person, is my opinion. For example, there may be kind of very bad ideas getting funded, like kind of lot of money. there can be very good ideas which are left by investors because they don't find it exciting or something. The question that you have asked, in that case, what they should be looking for is a bank fund. But like banks without collateral, maybe they will be providing only up to 10 lakhs loan. Or we have the CGTMSC scheme wherein we can get some up to a 2 crore or something is there, but that is definitely dependent on their turnover. On an idea stage, they will not get that.
Yeah, sorry. I mean, not that we have to solve the problem here, and apologies to the rest. But so here, they didn't want to go to the bank funding straight away, and this was more of a seed money to actually pay advance.
No, I do agree that all of this is happening because of the what I am actually trying to solve through this webinar series is also that only. Like there is a lot of buzz around startup. People, so like many people think that kind of when we have an idea or when we start a business, then it is fundable. Then we'll be getting fund. They straight away start looking for fund. In my opinion, in my honest opinion, what I would tell people is that if you have an idea and if you believe that it is going to be good and you have that conviction this is going to be a successful business model, first of all, you try to put in whatever money you have. I won't tell you pledge your house and do a business or anything, but you try to put in money you have, try to build a prototype. If that is not sufficient, approach your friends and family, try to raise money like that, and then build a kind of, the revenue-based financing is an option. That is their param, but
the only thing, sorry, Abhijit, the only thing was, it was again in terms of an agreement on the equity. While I was prepared to fund maybe a 2 CR, the whole question was, what was the equity stake and what was being offered was too less. So how do you actually evaluate even when the revenue has not started kicking in was the question,
there are multiple aspects for that. See, in a proper fundraising event for a startup, valuation is not actually a necessary thing. So we can, if we are not able to value a company at this point of time, there are options like convertible notes and there are options like convertible debentures, wherein the valuation happens at a very later stage. You understand? So there are options like this in the startup thing. And evaluating a startup is a very that's what I was telling in the initial intro part also. Like even with this, I don't think I can give you clarity on how to value a startup, but I can give you some factors what affects the valuation. See, it all depends on a lot on negotiation and things. Like if you guys have watched Shark Tank, we see people telling that I'm asking 10 crore. I'm asking 1 crore for 10 crore valuation. That is 10% equity. Then Aman Gupta comes and tell, I'm ready to invest 50 lakhs at 5 crore or whatever. Like these things actually happen there. So it actually depends a lot on a negotiation and the person whom you are pitching. It's not only the business founder's conviction. Like, see, my startup is, I am valuing my startup at 10 crore. So the investor should fund at 10 crore. That's not a practical way of dealing with it. Either you will have to kind of get validation from a couple of investors whom you have in your personal connect, ask them what the good valuation would be, or maybe you can evaluate a similar model and see how they have gone from scratch to scale. Like we cannot take the revenue multiplier or anything that they have taken at a later stage. Maybe they have raised say 1,000 crores at like 100x revenue multiplier or EBITDA multiplier. That cannot be considered for an early stage, but you can take their growth stage as an example and have a tentative kind of value for your startup and then pitch to the investor. And then definitely there will be a negotiation, and based on that, these things would be happening.
Hey, thanks, Abhijit. Really appreciate it.
So I'll just continue with the session. We can have remaining questions later. Yeah. Okay. Yes, hope my screen is visible. Can type out if it is visible. Okay. Yes. So yeah. So now now we'll actually discuss on like to have a overview on why to raise funds and how much fund to raise in a company. So by this, I actually see there are basically broadly categorized. There are only two aspects for which you need fund. One is for the operational cash flow, and other one is for the asset building or fund type setup. So when I say operational cash flow, the marketing and advertising expenses, for example, few models are heavily dependent on marketing because we need to do a lot of performance marketing and advertising to generate lead and then to convert them into clients and then sell our products. So that is actually an operational cash flow because that kind of keep on recurring and like kind of it is always part of the profit and loss. And then we may have a salary intensive model wherein we have to fund the salary for 10 months because the revenue is supposed to happen only after 10 months. Okay. For 10 months, we are developing the product, and from 11th month or only, or after 1 year only, revenue would start clocking in. Then in that case, we'll have to kind of find fund for salary and 11, or maybe rent, like whatever are the operational expense for that, we may be requiring funding. And another example could be a deficit in operational cash flow, that is excess of expense over revenue. For example, you have started clocking in some revenue, but that is not sufficient to meet your expense, but you expect in another 10 months time, your business would be stable. So there will be a deficit. For example, you have 5 lakhs of revenue, but you have 10 lakhs of expenses to meet on a monthly basis. Then you're looking at a 5 lakh of negative cash flow over a period of 10 months. So 5 lakh into 10, it's 50 lakhs of operational cash flow deficit is there. So that is something you would actually be required for your funding. Then we have the asset building or one type setup. For example, we may have to kind of move to an office space wherein that cost can be we may be requiring fund for that. For creating an intellectual property, when I say intellectual property, people are, like I told, people are working on some software. So the time that there may be a R&D team and there may be a team who is solely working on developing the product, and there will be other operational staff as well. So in that case, the people developing the software would be treated, their expense would be treated as an intellectual property expense. And for developing an intellectual property will be requiring fund. And then also for purchasing assets. For example, we may be requiring a lot of computers, we may be requiring, we may be requiring some machineries, we may be requiring some, or whatever, like whatever assets are required, for that also will be requiring fund. So in totality, the funds to be raised is the operational cash flow deficit plus one-time cost. So, why I'm telling you this is because we usually, or when I usually see a fundraising activity, startups come and tell me like, okay, we are planning to raise 2 crore. Okay, the first question what I ask is, what are you going to do with this 2 crore? So then they tell like, okay, we have to do marketing for 1 crore. We have to do 50 lakhs of office setting up and other things. Then the remaining 50 lakh is for working capital. So people actually come up with a round figure to raise fund, and then they may be having genuinely requirement for the fund, and the difference they put it as working capital. So working capital is nothing but the it's actually the operational cash flow. Like technically it may not be correct, but for a broader understanding, I would treat it as an operational cash flow. So in this manner, so you create a kind of sheet wherein you what is your expected revenue and what are your expected expenses over a period wherein you until you become break even. Then that deficit is the working capital that you require plus what all one-time expenses you require. Maybe creating the intellectual property or purchasing the asset or whatever. So summing up, these two would be the total funds what is required to be raised by a startup. And it's not like the other way, you go for a round figure and then you back calculate. See, I see a lot of startups doing this mistake. They come up with a round, how like, see, even asking 1 crore 33 lakh 25,000 is as, I mean, that is the correct way to ask rather than asking for 5 crore and then back calculating like how we are going to spend this 5 crore. That's not the right approach to take. It should always be ascertaining your business plan, like how you are going to spend your fund and for what all things you would be requiring fund, and then ascertaining the gap and then asking the investor for that fund would be the right approach to do it. Is this part clear to everyone? You can type out yes if this is clear. Okay. So Jagdish. So see, what I was telling is that usually how startups do, or one wrong thing what I've noted startups doing is that they actually come up with a bulk amount, say 2 crore. So we are going to raise 2 crore, and then they back calculate how they are going to utilize the 2 crore, which is actually a wrong way of doing it. The right approach is to kind of identify what your operational cash flow or operational cash flow deficit is, and also what amount do you require for asset building or one-time setup, and then summing up the two and asking for a fund. So people usually do the other way, like they have a figure, round figure, then they tell that okay, we have 2 crore, now we are going to raise 2 crore. Let us spend 1 crore on marketing. So, but actually, we may not be requiring that much amount for marketing. So it should be always kind of creating a business plan wherein we estimate the expenses, we estimate the overheads, and then we arrive at an operational cash flow deficit which need to be funded, and also what cost we require for setting up this business, for setting up an office space, for setting up or for purchase of asset. And summing up these two should be the manner in which we should be actually approaching the fundraising process. So why to raise fund? These two questions are, I mean, these two are the answers. And like, okay. So is it clear? It's clear now, right? I can move to the next slide. Fine. Okay. Yeah. Yes. So yeah. So this is the prerequisite for a fundraising. So one thing, you should be having a business that solves a problem and which is scalable and can have a mass outreach possibility. That is what we discussed earlier. It should be a startup. So that is one thing. Then after that, you can have your business idea validated by industry experts. So if you have some consultants in your network, or if you have some investors in your network, if you have some like kind of VC fund in your network, maybe you can pitch to them on a friendly note, take their suggestion, pivot your model. That should be done before reaching an investor, because we may not get multiple options, I mean, multiple chances to pitch to the same investor. So I would always suggest to fine tune the business model what you have, to create it in the maximum neatest possible manner, and then pitch to a VC fund. Then the business must be registered as a private limited company. This can be a contrary opinion for many other consultants, but a person who has been in the startup domain for 5 years and who has been working with investors and startups, your company should be registered as a private limited company. Your business should be registered as a private limited company if you are doing the startup fundraising model. If you are doing an MSME model financing or any other model financing, then in that case, you can register your business as an LLP or a partnership, as the case may be. But if you are looking for a startup fundraising model, your business should be a private limited company. Then we should obtain a startup India registration and apply for angel tax exemption. Why I'm telling this is a prerequisite is that whenever we raise fund from a investor, we do it at a valuation. So we will be actually giving shares of value of say 1 lakh rupee for 1 crore rupee. So that is the valuation game. So actually, the capital you have invested in your business is say 10 lakh. 1 lakh is 10%, and you are diluting 10% for 1 crore. So you are actually giving 1 lakh worth shares for 1 crore. So there is actually a 99 lakh difference, which is the securities premium, which is a technical aspect which we will be discussing later. But for your understanding, we are giving only 1 lakh worth share to an investor who is investing 1 crore rupees. So the 99 lakh securities premium, in order to be not taxable, you should be having a Startup India registration. So the tax on that the Income Tax Act actually specifies that this 99 lakh should be treated as other income and should be taxed accordingly. That tax is called angel tax. But if you have a Startup India registration and you get an angel tax exemption, you will get rid of this thing. So whenever you are planning for a fundraise, definitely you will be issuing your shares at a premium, and this angel tax thing would be popping up. So in order to avoid that, obtain a Startup India registration and apply for angel tax exemption. Then the next thing is that create a formal pitch deck that covers all the aspects, the problem, the solution, the team, how much funds are required, and everything. So I told we'll be having a separate episode on pitch deck later. But for now, we'll just have this understanding, create a formal pitch deck that covers all these aspects. What is the problem? What is the solution? And all those things. Then the next thing is obtain a valuation report. This is what you might have heard from a lot of consultants. But in my case, I'm actually completely against this concept. So if you meet a consultant, if you meet somebody during a networking session, if you are a pre-revenue stage startup or something, see, in my experience, at a very early stage, none of the investors ask for a formal valuation report. Valuation report is asked by the Companies Act and FEMA guidelines only. I mean the RBI only for from a compliance perspective. Not many investors ask for a valuation report at a very early stage of fundraising, because the question what we were addressing before. I don't remember the name of the. I think it was KL Kumar who asked the question. So see what I answered at that. Yeah. So what was the point? What required again explanation? I'm just seeing the chat box now. Can I continue? Okay, so the question what KL Kumar asked was how to value at that point of time. See, even if you have a formal valuation report from a consultant or a registered valuer or whoever it is, see, that will not be considered by an investor. The investor would be negotiating on that terms, because see, the value what you determine or an consult. See, there are a lot of factors affecting the valuation of a startup. In some bigger deals, for example, in some acquisition deals or something, I've seen maybe the investor may be asking for a valuation report from the big four firms like KPMG, Deloitte, Pricewaterhouse, PwC, and then like GT. They may be asking an independent valuation report from these firms to determine the value of the company. But for an early stage startup, I never see any investor asking for a valuation report unless and until they are going for a second round of fundraising or a third round of fundraising, wherein they ask the valuation report of the previous round. So, like I told, from a compliance perspective, you need a valuation report, but that can be obtained once you. That's not a prerequisite for a fundraising. That is required only after a later point of time when you are very sure that the fund is going to come. When you have the terms negotiated with the investor, you have a proper term sheet in place. In that case, only you get a valuation report. Else, you don't get a valuation report. But this is, I would really like to call it as a scam, wherein a lot of consultants actually pitch into startups and they ask them to obtain a valuation report at the first place itself. So the only people who is benefiting from valuation report in the early stage is that consultant who does the valuation report for you. They'll be getting a good amount of fee, but I wouldn't recommend you to fall for such things. This may be an unpopular opinion. This may be a harsh truth. Yeah. Plus, there is a cost for valuation, and the startup can avoid that. That is what I'm telling, Param. So I don't want anybody to. I see even my client. I don't ask them to do any unnecessary thing. I try to avoid whatever costs that can be avoided at this point of time. See, definitely once you raise fund and you have fund, maybe like kind of you can try doing these things. What agencies will do valuation report, which investor may recommend. See, no investor would be recommending at this point of time, at an early point of time. But in some case, in some acquisition deals or something, there may be, see, it all depends from deal to deal. It is not that any investor would be recommending this agency to do a valuation. There is nothing like that. Let me be very clear. I just told an example wherein in some cases that can be that ask the investor to get it done. But there, yeah. So Param is kind of telling something there, but yeah, that's a very controversial topic to discuss. But it all depends on kind of deal to deal. what volume you are operating, what is the amount of fundraising that is happening. And I always like to connect it with there is an associated cost with every fundraising activity. So, like maybe if you're raising 1 crore, you may have to spend around 2 to 3 lakhs for the compliance valuation report, for the due diligence and everything. Like maybe 2 to 3 lakhs would be there. If the amount goes to kind of say 2 crore also, then it will be going to maybe 4 lakh only. So the percentage actually reduced. So 4 lakh is just 2% of 2 crore. In the same matter, 3 lakh is 3% of 1 crore. But if you're raising only say 10 lakh also, then there is an associated cost. So in order to keep that cost less, initially don't go for a valuation report. Even if some consultant come and tell you that you need to get a valuation report, get the valuation report done only if an investor insists, if you have a proper term sheet, if you are sure the investor is going to fund into your company. Else, it is not actually required at this point of time. But definitely from a compliance perspective, you need a valuation report, but that can be done at a later point of time. So these are the prerequisites for a fundraising. You should be having a business that solves a problem which is scalable and can have a mass outreach possibility, which is actually the definition of startup, what we discussed in the earlier stage. Get your business validated by industry expert. You can be your friend who is a chartered accountant, your friend who is a consultant, your friend who is a VC fund, like kind of a manager or somebody, your friend who is in business for many years. He has a lot of experience. So discuss your idea with a lot of them, get their validation, get their opinion, listen to their questions, try how you can improve your model in a better way. Yeah, that should be done. Then the business must be registered as a private limited company. If you're going for the startup fundraising route, your business should be definitely registered as a private limited company. Then obtain the Startup India registration and apply for the angel tax exemption. Like I told, you'll be issuing 1 lakh per shares for 1 crore rupees. So there will be an angel tax thing coming in. So it's mandatory, or it's important to get a Startup India registration and get the angel tax exemption in that case. Then create a formal pitch deck that covers all aspects, the problem, the solution, the team. So we will discuss about the pitch deck in a later episode. I hope that is clear. And don't obtain a valuation report. So obtain a valuation report is what most of the consultants would be telling. So even for me, it is beneficial if you get a value. I'll get some money, but you won't be benefiting from that. So a valuation report is not going to benefit you at a. See, I see a lot of startup approaching me and telling that this valuer has valued my startup at 130 crores. And 200 crores. So we are planning to raise 30 crores at 15% dilution. So it's that startup hasn't started making revenue, and some valuer has some consultant has approached them and he has given a valuation report for 200 crores. Which investor is going to fund that valuation? I'm not sure. See, no investor would be funding a pre-revenue. I'm not selling it is impossible, but it is near to impossible unless and until you come up with a like a groundbreaking idea or something which is kind of very valuable. Only you'll be getting that sort of valuation for a pre-revenue stage startup. I've personally seen it, and I feel sad for that founders. Like kind of they're getting fooled by this thing. They're pitching to me stating that we are looking at a 200 crore. We have a valuation report. Can you pitch to an investor? See, I cannot approach any investor telling that this pre-revenue stage startup is going to have 200 crore valuation, because that is not the right way to approach it. So I hope this is clear. Now we'll just move to the next slide. So the fundraising process overview. In this slide, like so, the first thing to do is definitely you should be having after the prerequisite. Okay, so the prerequisites are done. We have a prerequisite. Then in that case, we should be doing investor outreach. That can be through your connections. You may be having a chartered accountant. He'll be having some connection, or you'll be having startup founders who are friends who has raised funds or who has not raised funds, but they have connected with some VC funds or investors. By that way, you can reach out to them, or you can reach out to funds through LinkedIn. In LinkedIn, like most of the capital, I mean the VCs or angel networks are there on LinkedIn. You can do a cold message and see if they will be giving you the mail ID to kind of send your pitch deck. And also, if you visit the website of some angel funds or micro VCs, There you can submit your pitch deck. They'll be reviewing it and evaluating. And if your idea seems good, they'll be calling back. So you'll have to send out the pitch deck at that point of time. That is the reason why which I'm telling, like, pitch deck is kind of an entry ticket for the fundraising. So it should be aesthetically good. It should be like kind of content wise, it should be good. It should be self-explanatory, because in many of the cases, you will not get a chance to explain your pitch deck at an initial point of time. So you'll be sending out a pitch deck, and then the investor has some interest by seeing your pitch deck. Then only you will be able to explain. So it should be a self-explanatory one. Your pitch deck should be it should be simple to understand, and it should be self-explanatory. It should be aesthetically good is what I would suggest, because in my experience, in my opinion, like chances are high that a good pitch deck, good looking pitch deck with good content and with good clarity would be seen and understood by a investor, and they would be reaching out to that founder easily. Okay. Then after you send the pitch deck, you get on a call with them, and then the investor get convinced with your business model. And then you have this negotiation kind of thing, what we told about the valuation. And so suppose we negotiate for a 10 crore valuation, and the investor is putting in 1 crore money. So this is another different thing. So in the coming episode, we'll be discussing about how to value, like what are the, like I told, I won't be telling after this seminar, don't think that you will be able to value a startup technically and like kind of pitch to the investor, but I'll give you some ideas on what all factors affect valuation and everything. So once the investor get convinced and you convinced with your business model, and you guys agree on a valuation and the investment amount, then the investor would be issuing a term sheet. So a term sheet is nothing but it's a non-binding agreement. So having a term sheet doesn't mean that you have your funds secured. There are a lot of processes coming after term sheet, but term sheet can be treated as a good indicator or good sign of your fundraising process going in the right path. So actually the investor agrees upon the terms, and there will be many things actually in the term sheet. And one such thing would be the due diligence. So after the term sheet is issued, the investor may ask your company to get a DD done by a chartered accountancy firm or a consultant firm. So in a DD, what we actually do is we evaluate the business of the startup. We evaluate their revenue model. We evaluate their numbers. We evaluate their compliances, like whether they are compliant, like whether they are adhering to GST compliances, whether they are adhering to TDS compliances, income tax compliances, FEMA compliances, whatever is applicable to them, we'll be looking. So this DD would be coming after the term sheet. And after the DD is done, there will be a few things like conditions precedent. So conditions precedent are the conditions which should be fulfilled before a fundraising happens. Okay, so yeah, so like when the DD is done, suppose I do DD for a startup and I find out that their GST filings are not proper. So DD is due diligence. Jagdish, DD is due diligence. So I do a DD for a startup, and then I find out that their GST returns are not proper. So their GST, they haven't filed GST return for 5 months. So one conditions precedent could be the company should file this 5 months GST before the fundraising to happen, or before the agreement would be signed. So there will be list of conditions which would be a prerequisite to the funding, like apart from the prerequisite what we have told. So this will be known only once the investor has a preliminary evaluation and once the due diligence is done for your startup. Then after that, the signing of agreement and the transfer of funds will be happening. So we'll be having a shareholders agreement or whatever definitive documentation. And after that, the investor would be transferring fund. And after funding also, the fundraising process will not be ending. After fundraising, after the funds sit in your account, you will have to do a lot of post investment compliances. Even you will have to file the forms with ROC, after which only you will be able to use the fund. So you get 1 crore, then that moment you cannot use that fund. You will have to file proper form with the ROC, and once that is approved, only you will be able to use the fund. And even for getting the fund, you should be having a separate bank account. There are many conditions like that. We'll discuss that in detail in the upcoming episode. Then if you are getting funds from abroad, that is, you are having foreign direct investment, a foreign investor is coming in, then you will have to go ahead with the RBI filings also. So that is something a part of the post investment compliance. And then there will be this fulfillment of conditions subsequent. So like I told for conditions precedent, there will be conditions subsequent which need to be done after the fundraising is done. So one such example would be the post-investment compliances itself. So the investor would be telling in the agreement, it would be mentioned the startup should do all the relevant filings with ROC related to fundraising within 30 days of funds sitting into the account. That can be one condition subsequent, or if there is some milestone based thing. For example, the startup need to kind of bring in 1,000 new customers within 3 months. That can be a condition subsequent. So that thing also would be part of the fundraising deal. So this is just an overview. There are many different layers of a fundraising deal. There can be a fundraising deal without these processes, what I have mentioned, because there are very small fundraising deal which happens kind of without much complexity also. There are a fundraising deal which happens with a lot of complexity, and in that case there will be a lot of other things more than this. So this is all about the fundraising process, and this is all about my first episode. Now we can have a question answer session is what I think. So yeah, if anybody have any question, please raise the hand. I'll unmute you. Or I'm actually giving you the option to unmute yourself. Yeah, hi. Does anybody have any question? You can ask the question like in the message. Others, you can ask the question. It's fine. I think I have given the option to unmute. Also.
Hello.
Yeah. Hello. Yeah. Arul, hi.
Hi. The presentation was quite interesting. When does the foreign direct investment play an important role in the startup company? Can you please explain?
See, it all actually, like I told, like there are many domestic investment companies. There are many companies who invest domestically. But see, if you have some outreach to foreign VCs, you can actually pitch. See, that's actually kind of very. There is no like kind of peculiar saying like it is very critical for a company. It's very critical for a startup. Suppose some model what you're developing is more sellable in a more sellable in say in other part of the world. For example, it's more sellable in US, and the fund that you know is a outside fund who actually has invested in similar startup. Then it will be easy for them to understand that okay, this model is going to work. Than an Indian fund. In that case, you can go for a foreign fund. Like if it's a non-fund, like there are few foreign funds which can be like kind of very sector specific. They invest in these sectors only. Like apart from that, there is no such differentiation as like a company should get foreign direct investment or like there is no such difference as it is, Arun.
Okay, we no need to prove that we are the startup company which we are covering the foreign direct investment. We no need to prove, right?
No, there is nothing like I know many companies who has raised a lot of funds, but they haven't raised any foreign investment or anything.
Okay, thank you. Understood.
Yeah. So Agris was mentioning, was messaging something. So yeah, let's say we have developed a technology product, then should we hire one CEO or any famous company to which can do all the tax work? See, the thing is that if you have a product or if you see, just ensure that your basic compliances are done properly. Don't go for like kind of high-end CFOs or high-end consultants at the initial stage. So if you once an investor comes in, then it's a different thing. So in that case, you cannot actually mess with your compliances or anything. But even at an early stage, also, I'm not telling you to mess with your compliances, but get some decent guide, understand like what they are doing, have a basic understand on what all filings need to be done for a company. What are the annual? You can ask. Definitely, you'll be having a chartered accountant if you are having a private limited company because an auditor is mandatory for a private limited company. You can sit down with them and understand like what are the yearly filings for a company. So I'll just give you some examples. There are GST filings, so that is one part. Then there is this TDS and income tax filings, which is another part. Then we have this ROC filings, which is the MCA and Ministry of Corporate Affairs part. So you can ask the chartered accountant or the consultant like what all comes here and what all things are. What all filings do? What are the periodicity of these filings? For example, GST needs to be filed monthly. TDS payment needs to be done monthly. The filing need to be done quarterly. Most of the ROC filings are annually only. Unless and until you have some peculiar events happening in between the year, like when you appoint a new director, when you raise some funds. Apart from that, there will be no other ROC filing coming in between the period. So there will be a proper periodicity for this. Have a basic understanding, and maybe you can keep a calendar for yourself and just tick all these things so that you don't kind of miss out on any filings or anything. But in the initial stage, I won't recommend you to go for a high-end costing if you're doing like kind of not much revenue at this point of time. Keep your expenses also low, and once your business start developing and it starts becoming complicated, at that point of time you can actually go for a like kind of good firm. Yeah. Anybody else have any question?
Will you be sharing the link of this recording to all the people in the WhatsApp group? Because I think I lost 1 hour. I was not able to make it. So
yeah, definitely. But there was a small issue. I started recording after a while only, so the initial few part would be missing. I'm not sure whether Dinesh has actually recorded the whole session, but definitely if you have a full link, I'll be definitely sharing. Anyway, I have a recording, but I think I missed the first 10-15 minutes or something. Yeah. Definitely we'll be sharing that. Anybody else have any other question? So yeah, the next session and everything will be yeah. Dinesh, can you just share the WhatsApp link? Yeah. Okay. So the WhatsApp link is there. You can join to that group and you can reach out to Dinesh if you have any queries or anything. The next session we will be updating it in the WhatsApp group, and from now onwards we will be having 1 hour sessions wherein we can have 45 minutes of session and 15 minutes of Q&A. And since this being the first session, I thought I'll just keep a 2 hours buffer and like take more questions. And yeah, so the next session we haven't actually decided the date, but it will be on a Saturday around the same time, like 6 to 9 p.m. In that time zone, we'll be having the session. Yeah, because we actually had a poll on which day and which timing suits the listeners well, and we got more response for Saturday and this time slot. So we'll be definitely having on Saturdays only. Maybe sometimes we can have a small session next Saturday. Yeah, but we'll be updating it in the group anyway, and we'll be sharing it on our LinkedIn and other portals as well. Yeah, if that is it, like we can wind up the session. Thank you everyone for joining the session. I had kind of good number of inquiries, but many people were not able to join, I think. So in the next session, I hope let everybody be able to join. Thank you for your time. Thank you for asking the doubts. Thank you for making it an interactive session. Thank you, everyone. Bye.
ठीक है,
Good
हुआ
night.
उसका ऑपरेशन?
Yeah,
ये
Jagdish.
इसका हुआ, I think ये विशाल गुप्ता
Your voice is not audible. Jagdish.
हर्षद सर से बात कर रहा
Hello.
हूँ। ठीक है।
Yeah. Okay. So thank you, everyone. Thank you. Good night.